Hello everyone. Today, we will explore the journey of Malaysia's currency, how it weakened over time and what factors have recently contributed to its recovery. Let's begin by understanding some key concepts.
I bet you didn't know how fascinating the Malaysian ringgit is. According to the My Government portal, the Malaysian ringgit, or MYR, is the official currency of Malaysia. Since August 1975, the name ringgit was officially accepted as the proper name for the Malaysian currency. As stated by Bank Negara Malaysia, the Malaysian ringgit value, like many currencies, has gone through cycles of appreciation and depreciation. These changes are influenced by trade performance, interest rates, political stability, and global market trends. Its performance reflects not only Malaysia's domestic economic health, but also how well the country responds to international challenges. Understanding this context helps us appreciate why the ringgit's value has moved the way it has. With this background in mind, let's now look at one of the more challenging phases, which is the depreciation of the Malaysian ringgit.
Just a year ago, the Malaysian ringgit was under pressure, but today, it's showing signs of strength. What's behind this turnaround? Let's explore the key factors driving the ringgit's appreciation. The first major factor is the global and domestic economic recovery. As the world rebounds from previous downturns, Malaysia's trade and investment flows are increasing again. At home, consumer spending and industrial activity are also picking up. In 2024, Malaysia's economy grew by 5.1%, giving investors confidence in the country's fundamentals. Second, Bank Negara Malaysia has played a smart role. Through a mix of stable monetary policy and targeted fiscal measures, the central bank helped support the ringgit. Interest rates were maintained at a reasonable level, inflation was kept under control, and foreign reserves remained strong. These factors have supported the ringgit's stability and attractiveness to investors. Next, we've seen a rise in foreign direct investment, or FDI. Companies from around the world are investing in Malaysia's manufacturing, digital, and green technology sectors. According to MEIF 2024 alone, Malaysia recorded over 76 billion in approved investments. This inflow of foreign currency increases demand for the ringgit, strengthening its value. Another key is the rise in Malaysia's export prices. According to trade-mix products like semiconductors and palm oil, two of Malaysia's top exports, saw price increases on the global market. This means more foreign buyers are exchanging their currencies for ringgit to pay for Malaysian goods, increasing demand for the currency. Finally, Malaysia's trade with major partners like China, Singapore, and the United States has remained strong. According to Trading Economics, these countries continue to import Malaysian goods and services in large volumes. This steady and growing trade contributes to a healthy current account and supports the ringgit's value. So, why is the Malaysian ringgit appreciating? According to Trading Economics, it's a combination of smart policy, global recovery, rising exports, foreign investment, and strong international trade. While future challenges may arise, for now, the ringgit's appreciation is a positive signal for Malaysia's economy.
Hi everyone, today I'm going to explore why the Malaysian ringgit has weakened relative to major currencies. Over the year, the ringgit has depreciated over 2.7% against the US dollar, with its trading value only at 4.23 MYR per USD as of May 25, 2025, compared to around 4.11 MYR per USD a year before. Currency depreciation has a lot of impacts. It raises the cost of imports, fuels inflation domestically, affects earnings for companies with foreign currency debt, and even influences monetary policy. Now, let's break down the 5 key drivers: low domestic interest rates, political instability, falling commodity prices, foreign capital outflows, and the lingering impact of the COVID-19 pandemic. First up, low interest rates. On May 8, 2025, Bank Negara Malaysia kept the overnight policy rate at 3.00% for the 10th consecutive time, a decision in place since May 2023 due to subdued inflation and a cautious outlook from slowing external demand. Meanwhile, the US Federal Reserve held its target range at over 4.25% to 4.50%. This 125-150 basis point difference makes ringgit-denominated assets less attractive to global investors, pushing capital into higher-yielding US dollar assets. The result? Reduced demand for the ringgit and continuous downward pressure on its exchange rate. Next, political instability. Since 2020, Malaysia's political scene has been anything but calm. The Sheraton move in February 2020 overthrew the ruling coalition, and within just 2 years, Malaysia saw 3 different prime ministers. Frequent changes and the major cabinet reshuffle in December 2023 disrupted policy continuity and eroded investor trust. After the mid-2021 turmoil, the ringgit temporarily dropped to 4.2430 per USD, its lowest since July 2020, as global investors waited for clarity on fiscal policy. This political uncertainty increased volatility in both bond and currency markets, fueling further depreciation. Let's talk about falling commodity prices. Malaysia is the world's second biggest palm oil producer, but in 2025, global production rose and biodiesel demand dropped. This pushed expected prices down to 4,200 MYR per ton by mid-2025, and export volumes dropped by 5.3% in 2024. On the oil front, Brent crude averaged $74.33 per barrel in early 2025, but dipped below $70 by September 2024, decreasing petroleum export earnings. OPEC plus supply increases and US stockpile growth kept oil prices low, weighing on Malaysia's revenue. Foreign capital outflows are another key issue. Global risk-off events and policy uncertainties led to significant foreign investor withdrawals from Malaysian assets. In November 2024 alone, non-resident investors pulled out a net total of $1.92 billion from Asian sovereign bonds, including Malaysia, marking the largest monthly outflow since early 2020. This reduces demand for ringgit transactions and adds more pressure for depreciation. Finally, the lingering impact of the COVID-19 pandemic. In 2020, Malaysia's economy shrank by 5.6%, the largest drop since the 1998 Asian financial crisis. Strict lockdowns decimated tourism, retail, and manufacturing. GDP fell by 16% in Q2 2020. Massive fiscal stimulus raised public debt from 53% to 63% of GDP, sparking concerns about fiscal sustainability and putting even more downward pressure on the ringgit. In conclusion, the ringgit's depreciation reflects a mix of accommodative monetary policy, political instability, fluctuating commodity prices, capital outflows, and pandemic-era economic scars. To stabilize the currency, Malaysia needs to gradually raise interest rates, strengthen governance, diversify exports beyond palm oil and petroleum, establish foreign exchange reserves, and maintain prudent fiscal management. By taking these steps, Malaysia can work towards more sustainable currency stability.
Now, let's look at the impact of ringgit fluctuations on different sectors in the Malaysian economy. When the ringgit weakens, consumers are the first to feel the impact. Prices of imported goods, such as electronics, food, and fuel increase, leading to a higher cost of living and reduced purchasing power. On the other hand, a weaker ringgit can benefit exporters, as Malaysian goods become cheaper and more competitive in the global market. This can help boost export revenue and support local industries. However, exchange rate volatility also affects foreign investors. A stable ringgit helps build investor confidence, while uncertainty may reduce foreign direct investment or lead to capital outflows. Lastly, for the government, a weaker ringgit can increase the cost of servicing foreign debts and impact national spending, especially on infrastructure and imports. Now, let's examine a real case study in actual exchange rate data, which shows the trend of the ringgit against the US dollar from 2020 to 2024. From 2020 to early 2021, the ringgit remained relatively stable, trading between 4.10 Malaysian ringgits and 4.20 Malaysian ringgits per US dollar. During this period, the global economy was still recovering from the initial impact of the COVID-19 pandemic, and interest rate differences were minimal. Starting from mid-2021, the ringgit began to weaken. This coincided with the widening of the yield spread, as the U.S. Federal Reserve began increasing interest rates aggressively to control inflation. The rise in U.S. interest rates made U.S. assets more attractive to global investors, causing capital outflows from Malaysia and leading to further depreciation of the ringgit. By mid-2022, the ringgit had fallen to above 4.40 Malaysian ringgits per U.S. dollar. The situation continued into 2023, with the ringgit reaching a low point of around 4.75 Malaysian ringgits as shown in the red trend line. However, in late 2023 and early 2024, the ringgit began to stabilize slightly, trading between 4.60 Malaysian ringgits and 4.70 Malaysian ringgits. This was due to several factors, including improved political stability in Malaysia, moderate global economic recovery, and policy efforts by Bank Negara Malaysia. The data clearly shows that the fluctuation in the ringgit's value is closely linked to global financial trends, especially interest rate policies in the United States. When the US raises its rates, investors move their capital to US markets, causing pressure on emerging market currencies like the ringgit. This real-time case study helps us understand that managing currency value requires not only local economic strength, but also resilience against external global pressures.
In an open economy like Malaysia, maintaining economic stability is crucial. This responsibility falls largely on the government and Bank Negara Malaysia, the nation's central bank. Let's take a close look at 3 key stabilization measures they use to manage the economy. One of the most important tools is monetary policy, especially the setting of interest rates. When the central bank lowers interest rates, borrowing becomes cheaper. This encourages individuals and businesses to spend and invest more, which can stimulate economic growth. The second strategy is intervention in the foreign exchange market. When the Malaysian ringgit faces extreme volatility, Bank Negara may step in to buy or sell foreign currencies in order to stabilize the exchange rate. This intervention helps prevent sharp fluctuations in the ringgit's value, which could negatively impact imports, exports, and investor confidence. Thirdly, the government plays a role in encouraging exports by offering incentives to local businesses and improving trade infrastructure. Exporting more goods and services brings in foreign currency, strengthens the ringgit Malaysia, and improves Malaysia's balance of payments. At the same time, there must be control over capital outflows, which means regulating how much money leaves the country. Without proper controls, large outflows can weaken the currency and create instability in the financial system. These steps, interest rate adjustments, foreign exchange rate interventions, and export promotion with capital control are all part of a careful balancing act. Together, they form the foundation of economic resilience, helping Malaysia stay strong in the face of global financial challenges.
The journey of the Malaysian ringgit reflects both the challenges and resilience of our economy. In recent times, we have seen how global factors such as interest rate hikes in the United States, inflation and capital outflows led to the depreciation of our currency. At the same time, Bank Negara Malaysia states that with smart domestic policies, strong export performance and renewed investor confidence, recent appreciation in our Malaysian currency can be seen. The ringgit's value is more than a number. It affects our daily lives, influencing the prices we pay, the strength of our industries and the confidence of foreign investors. Bank Negara Malaysia 2022. The fluctuations we explored highlight the importance of sound monetary policy, active government intervention, and economic diversification. Most importantly, this journey shows that while global pressures are beyond our control, Malaysia can strengthen its position through smart decision-making, stable governance, and strategic economic planning. As we move forward, continued vigilance and adaptability will be key to ensuring that the ringgit and the Malaysian economy remain strong and competitive on the global stage.